Hello friends. Sounds complicated but actually quite simple. Mutual funds. Imagine you and your friends want a big, delicious pizza, but none of you can afford it alone. So you pool your money together, put it in one big jar, buy the pizza, and each gets a slice. A mutual fund works the same way. A pooled fund from many investors. It invests in different financial instruments. Stocks. Owning a tiny piece of a company. Bonds. Lending to a company or government. The main purpose: give small investors access to a professionally managed portfolio. Who manages this? A fund manager. Think of them as an expert chef picking ingredients, stocks, bonds, and other securities. The fund manager works at an AMC and does the heavy lifting. The fund's objective could be long-term growth or stable income. When you invest, you buy units of the fund, your share. The unit value, NAV, rises or falls with the underlying investments. This is revolutionary for the common investor. Previously, you needed a lot of capital-extensive knowledge and lots of time to invest directly. Buying shares of big firms like Reliance or TCS required substantial money. Mutual funds lower those barriers. With as little as 500 rupees, you can start an SIP and own a piece of a diversified basket. This democratizes investing for millions of Indians. It's like a personal finance manager working for you. The beauty is simplicity and accessibility. You aren't buying one stock, you're buying a strategy. Funds have goals. Invest in large, stable companies or seek high growth from smaller, emerging businesses. Find a fund aligned with your financial aspirations, risk appetite, and investment horizon. Saving for a down payment on a house, your child's education, or retirement, there's likely a mutual fund to help. It's your first and often best step toward long-term wealth. Now that we understand what a mutual fund is, let's explore the different flavors available in the market. The most popular category is equity funds. These funds primarily invest your money into the stock market, buying shares of different companies. Their main objective is capital appreciation over the long term. Think of them as the high-growth option. Within equity funds, you have subcategories: large-cap funds, mid-cap funds, small-cap funds. Because they are linked to the stock market, they carry higher risk, but also offer the potential for higher returns. On the other end of the risk spectrum, we have debt funds. These funds are the cautious and steady players. They invest in fixed income instruments, government bonds, corporate bonds, treasury bills. Essentially, the fund lends money to governments or corporations and earns interest on it. The primary goal of a debt fund is to provide regular, stable income and preserve your capital. They are generally considered much safer, suitable for low-risk investors or short-term goals, like a vacation next year. What if you want a mix of both safety and growth? That's where hybrid funds come in. Aggressive hybrid, 65 to 80% in equities and the rest in debt. A conservative hybrid prioritizes debt for stability, with a small equity kick. Great for newcomers seeking balance without picking separate funds themselves. Next up are index funds. These are a type of passive fund. An index fund manager doesn't pick stocks. They simply replicate a market index. Example, Nifty 50. Example, Sensex. A Nifty 50 index fund invests in the same 50 companies in the same proportions. With no active stock picking, expense ratios are very low. They offer a fantastic, low-cost way to get market-level returns. Finally, sectoral or thematic funds are high-risk, high-return, focused on a specific sector like technology, banking, healthcare, or infrastructure. These are for expert investors with strong conviction about an industry's future. So, why has the mutual fund Sahi Hai campaign been so successful? It's because these instruments have some incredible built-in advantages, or superpowers. The first and most important is diversification. We have all heard the saying, "Don't put all your eggs in one basket." A mutual fund lives by this rule. When you invest in a single stock, your entire investment's fate is tied to that one company. A mutual fund invests in dozens, sometimes hundreds, of different stocks or bonds. Even if a few lag, others can balance them, significantly reducing overall risk. The second superpower is professional management. Most of us have busy lives and may not have time or expertise to track markets continuously. With a mutual fund, you hire a team that studies companies and economic trends full-time. Another fantastic benefit is liquidity. You can sell units and have money credited within a few working days. ELSS has a 3-year lock-in, but offers tax benefits. Digital platforms make it easy to start, stop, or increase SIPs. SIPs help rupee cost averaging. You buy more units when markets are low and fewer when high, averaging your costs over time. With SIPs from Rs 100 or R500, wealth creation is accessible to every Indian. To understand mutual funds better, let's look at a real-world report card. It's important to remember that past performance is not an indicator of future returns, but it can give us some context. As of our check-in around late 2024 to early 2025, some funds have delivered stellar returns, while others have struggled. In the recent bull run, small-cap funds, sectoral funds focused on infrastructure, sectoral funds focused on manufacturing have done exceptionally well, riding economic optimism and policy support. Let's look at a top performer. For instance, a fund like the Quant Small Cap Fund has been a chart topper. Analyzing its performance over the past year, it might have delivered returns in the range of 45 to 50%. This outperformance is driven by an aggressive, agile strategy, identifying high-potential small caps early. However, the same fund can fall significantly in a bad year. High risk, long horizon needed. There will always be underperformers, often in sectors temporarily out of favor. For example, during global tech headwinds, a technology sectoral fund might have delivered negative or flat returns. A hypothetical ABC Digital India fund might show one-year returns of -5% to 2%. This doesn't mean it's a bad fund forever. The theme may be in a downturn. Diversification across fund types protects you from overexposure to one struggling sector. Some active large-cap funds fail to beat the Nifty 50 benchmark. If Nifty did 15% and a fund did 10%, you'd be better off with a low-cost Nifty index fund. Always compare against benchmark and peers, not just absolute returns. The key takeaway is to research, understand the risks, and not chase past winners blindly.